Imagine waking up tomorrow and realizing that the fundamental cost of just the food in your kitchen, the electricity keeping your lights on, even the clothes you buy for your family has effectively surged.
Right? Yeah.
And it continues to surge simply because the money in your bank account is, well, basically evaporating on the global stage.
Yeah, it's a terrifying thought.
Right. Your paycheck hasn't moved a single cent, your job hasn't changed, but your purchasing power is just draining away.
Mm-hmm.
That is the stark reality currently unfolding in Japan, where the yen has cratered past 160 to the US dollar. Welcome to the deep dive. We're looking into our sources today to really understand this incredibly volatile currency collapse, and more importantly, to understand the bizarre macroeconomic paradox it creates.
It really is a profound structural shock to a system that has been, relatively static for a very, very long time.
Yeah.
When a major reserve currency drops this rapidly, we aren't just looking at a slight adjustment in foreign exchange markets. We are looking at a fundamental rewiring of a nation's wealth. And the sources highlight a very specific divergence here. You have giant multinational corporations pulling in absolutely staggering, record-breaking profits at the exact same moment that the domestic working class is, well, they're getting crushed by an overwhelming cost of living crisis.
Okay, let's unpack this.
Yeah.
Because instinctually, if a national currency is in free fall, the assumption is that the entire nation is in a state of economic disaster.
Right. That's the standard assumption.
But the data shows this totally split reality. It acts almost like a massive economic centrifuge.
Oh, that's a good way to put it.
Yeah, you have this intense external rotation separating the massive multinational windfalls and kind of flinging them up to the top balance sheets, while the heavy, crushing pressure of inflation gets concentrated right at the center, bearing down on the everyday domestic consumer. So our mission today, for you listening, is to look at both forces within that centrifuge.
Exactly. And to understand the upward force, right? The massive profits. We have to look at the mechanics of global export dominance. To truly understand this, we need to look at both edges of the sword, how it affects the things Japan sends out into the world and the things it brings in.
Right. So let's start with the stuff they send out. The first edge of the sword. The good news, supposedly.
Oh, yeah, the good news for a very specific group. The sources point directly to major Japanese automobile and technology manufacturers. For these massive entities, a depreciating yen, it isn't a crisis at all.
No.
No, it functions as this colossal, invisible subsidy.
Oh, wow.
Yeah, because they're earning their revenue in strong currencies like the US dollar all across the globe. So when it comes time to repatriate that cash to bring those dollars back to Japan and convert them into yen for their, their quarterly earnings reports, the exchange rate math just goes absolutely wild in their favor.
Let me try to put this into an analogy for everyone listening.
Yeah.
Imagine you run a lemonade stand, but you sell to a neighborhood that uses a completely different currency.
Okay.
Suddenly your currency drops, so your lemonade is effectively half the price for them.
Right, so they're buying a lot more.
Exactly. They buy twice as much. And when you bring their money back to your house, the exchange rate magically doubles your profits.
Yeah, that's exactly it. What's fascinating here is how this specific currency drop acts as a massive invisible subsidy for Japan's biggest tech and auto giants. It completely alters their global export competitiveness without the companies changing their products at all.
That's the crazy part. The underlying engineering of their cars didn't change.
Right.
They didn't suddenly invent some revolutionary new microchip or streamline their assembly lines overnight. The physical product shipping out of the port of Yokohama is identical to what it was a year ago.
Literally the same car.
Exactly. But because the American buyer is paying with a highly valued dollar, the Japanese manufacturer is effectively selling the product at a massive premium when that conversion happens back home.
And the scale of that margin expansion, that's what catches the eye of global investors.
Yeah.
Let's look at the underlying mechanics.
Okay, lay it out for us.
So if a Japanese auto manufacturer sells a vehicle in the U.S. for, say, $40,000, a few years ago, that transaction might have brought roughly 4.5 million yen back to the corporate treasury.
Okay, 4.5 million.
But today, with the yen plunging past 160, that exact same 40,000 US dollars translates to well over 6.4 million yen.
Wow. Wait, really? Just from the exchange rate?
Just from the exchange rate. It is an enormous influx of capital dropping straight to the bottom line without the company having to lift a finger in operational improvements. It's a purely mathematical windfall generated entirely by the forex market.
Okay, but wait. If profits are booming for the big exporters, doesn't that cancel out the higher cost of living? I have to challenge the narrative right here.
Okay, go for it.
If we are talking about an influx of billions of extra yen flooding into the treasuries of Japan's biggest employers, why isn't that triggering a domestic economic golden age? It
Ah.
seems incredibly counterintuitive that record corporate profits wouldn't immediately spark, a massive reinvestment boom. These companies have the cash. Why aren't they building state-of-the-art factories, hiking wages aggressively, and pouring that money back into the local economy?
And that touches on the core limitation of a weak currency boom. The capital essentially gets trapped.
Trapped how?
Well, the windfall exists in yen, right?
Right.
But the tools required for massive domestic reinvestment, they're priced in strong global currencies.
Oh, I see.
Yeah. If a Japanese tech manufacturer wants to build a next-generation semiconductor fabrication plant inside Japan, they can't just pay for it with local yen.
Because the parts aren't Japanese.
Exactly. They have to import the advanced lithography machines, the specialized raw materials, the advanced robotics, and they have to buy all of that heavy capital equipment using US dollars or euros.
I see the friction. The buying power of their record yen profits basically evaporates the moment they try to look outward to purchase foreign-made capital equipment to upgrade their own facilities.
Exactly. The math heavily penalizes domestic reinvestment. So the money pads the balance sheet, it boosts the stock price, and it looks phenomenal to global shareholders looking at the corporate tax filing.
Right.
But it stays pinned to the upper echelon of the economy. It simply doesn't translate into dynamic, aggressive domestic expansion because the weak yen makes upgrading factory equipment prohibitively expensive. The wealth is totally isolated.
Which forces us to pivot and look at the center of that economic centrifuge, the domestic reality, the second edge of the sword.
The import nightmare.
Right. Because those factories, the supply chains that feed them, and the millions of citizens who keep the entire country running, they don't exist in a financial vacuum. They live on an island nation that is structurally reliant on the rest of the world.
Highly reliant. The sources quantify this with a really striking metric. Approximately 30% of the Japanese consumer basket consists of imported products.
30%, that's huge.
It's massive. And we are talking about the unavoidable necessities of life here. Food, clothing, basic agricultural products, household goods.
The stuff you can't just choose not to buy.
Exactly. When you import nearly a third of everything your citizens need to survive, a currency collapse instantly transforms into an engine of imported inflation.
And the timeline disconnect between the corporate windfall and the consumer paying. I mean, that's what makes it so severe, right?
Oh, absolutely.
A multinational corporation reports its currency-adjusted earnings at the end of the fiscal quarter. And maybe months later, that trickles down into a slight bump in a year-end bonus for a factory worker.
If they're lucky.
Right. But that same factory worker is paying for the weak yen at the grocery store this afternoon. The erosion of their purchasing power is instantaneous.
It creates an immediate degradation of the standard of living. The profits are concentrated at the corporate level, but the pain of a 30% imported consumer basket is felt by every single citizen.
Yeah.
The double-edged sword cuts the average consumer much faster than it helps them. And to make matters worse, this baseline imported inflation is being violently compounded by a secondary macroeconomic shock.
The energy squeeze.
Exactly. The sources explicitly highlight the rising global oil prices driven by geopolitical tensions in the Middle East.
Yeah.
You have to consider Japan's geographical constraints. The country imports the vast majority of its energy needs.
Right. They don't have massive domestic oil fields.
Yeah, not at all. They rely entirely on the global market for the oil and natural gas that powers their electrical grid, fuels their logistics networks, and keeps all those heavy industries running.
So they are caught in this brutal multiplier effect.
Exactly.
The raw commodity, the energy itself, is surging in price globally because of supply anxiety and conflict. And simultaneously, Japan is forced to buy that increasingly expensive energy using a currency that is actively hemorrhaging its purchasing power.
It's a perfect storm. That structural squeeze infiltrates every single layer of the domestic economy. The pain isn't contained to just the gas pump or the household electricity bill that, those spikes are devastating enough.
Right.
Energy is the foundational input for everything. The cost to power the refrigeration units at the local supermarket skyrockets.
Oh, yeah.
The diesel required to transport domestic agricultural goods from rural farms to urban centers becomes vastly more expensive. Even the utility costs for running local non-exporting businesses just surge.
It's a cascading supply chain nightmare. because every business that touches a product has to either absorb those escalating energy costs, which destroys their local profit margins, or they have to pass those costs onto a consumer base that is already seeing their real wages decline.
And the transmission mechanism of this pain is what eventually bridges the gap between the local grocery store and the highest levels of national monetary policies.
So,
Well, when the cost of living spikes this aggressively and this quickly, consumer confidence shatters, people stop all discretionary spending.
right, no more eating out, no more vacations.
Exactly. They hoard whatever yen they have left just to cover the bare necessities. And this massive drop in domestic consumption directly threatens the political stability of the ruling structures. Voters dealing with skyrocketing grocery bills and energy costs do not care about the record start prices of a multinational exporter.
Of course not.
They care that their standard of living is evaporating.
Which brings us to the broader financial markets, because that immense political and social pressure is forcing institutions to react. And the sources point us to a massive development in the Japanese long-term government bond market, where yields are, well, they're steadily rising.
Yeah, watching the Japanese bond yields rise is, it's like watching a dormant volcano suddenly show seismic activity.
Wow, that's a strong image.
Well, for decades, investors have looked at Japanese government bonds as a completely static instrument. The Bank of Japan has maintained a policy framework designed to pin those yields to the floor. So the rising yields we are seeing now indicate that institutional investors fundamentally believe the rules of the game are about to change.
Here's where it gets really interesting and honestly profoundly ironic.
Yeah.
Anyone who has followed global macroeconomics knows that the defining characteristic of Japan's economy for the last 30 years has been its desperate, seemingly endless battle against deflation.
Yep.
They have spent decades actively trying to generate inflation.
Decades. They faced an entrenched deflationary psychology that just paralyzed domestic growth. Consumers expected prices to be lower tomorrow, so they delayed spending today.
Right. Why buy a fridge today if it'll be cheaper next month?
Exactly. And companies expected weak demand and flat prices, so they refused to raise wages or invest in expansion. It was this vicious, self-fulfilling cycle of economic stagnation.
Right.
To fight it, the central bank utilized extremely low and even negative interest rates. They implemented yield curve control to essentially guarantee they would print infinite money to buy bonds and keep borrowing costs near zero. They tried every unconventional monetary tool ever theorized just to spark a minimal 2% inflation rate.
And now, thanks to a collapsing currency and geopolitical chaos in the Middle East, they finally have inflation well over their target.
They got exactly what they asked for.
Right. The central bank got exactly what it has been chasing for 30 years, but it's the absolute worst flavor of it. This isn't demand-pull inflation driven by a booming domestic economy or aggressive wage growth and high consumer confidence.
No, not at all.
It is cost-push inflation violently forced upon them by external factors.
And that means the Bank of Japan finds itself in an agonizing policy trap. To defend the yen and stem the bleeding of this imported inflation, the traditional monetary response is to raise interest rates, right? Making the currency more attractive to global capital.
Right, that's central banking 101.
But raising rates means abandoning the yield curve control that has artificially propped up their massive domestic debt for a generation. If borrowing costs go up, the cost for the government to service its own national debt just explodes.
Yeah, that's a nightmare.
Furthermore, hiking rates risks crushing whatever fragile organic domestic growth they currently have.
So the bond market is essentially calling their bluff. Traders are looking at the plunging exchange rate, they're modeling the compounding energy costs, and they're demanding higher yields because they're pricing in a new reality. They're betting that the political outrage over the cost of living will force the central bank to abandon its zero interest rate regime. The market is signaling that the era of the deflationary deep freeze is effectively over.
If we connect this to the bigger picture, it represents a historic regime change. For decades, global investors utilized Japan as a cheap funding source because interest rates were guaranteed to stay at rock bottom.
Free money, basically.
Right. Now, the internal pressure cooker of imported inflation is cracking that foundational assumption. The rising yields aren't merely a reaction to current commodity prices, they represent the unwinding of an entire generation of monetary policy. The global financial system is watching very closely to see how a major economy transitions out of a decades-long zero-rate environment when it's forced by external shocks rather than, domestic strength.
So what does this all mean for you, the listener? When we look at the totality of the sources, the depreciation of the yen is far more than just a localized foreign exchange story.
Hmm.
It is a brutal catalyst exposing the complex vulnerabilities of an import-reliant nation. It acts as that economic centrifuge we talked about, trapping massive corporate profits at the top while simultaneously inflicting severe compounding inflation on the everyday consumer at the bottom.
Perfectly summarized.
And most importantly, the resulting political and economic friction is forcing a historic, potentially chaotic pivot in a bond market that has been artificially subdued for over a generation.
It really demonstrates the inherent fragility of modern monetary policy. A central bank can design the most complex, controlled domestic financial environment imaginable, which Japan arguably did with yield curve control and negative interest rates.
Yeah, they wrote the book on it.
But a nation cannot isolate itself from the raw mechanics of global energy markets and currency flows. The outside world, with its geopolitical tensions and shifting capital tides, will eventually break through those containment measures.
Which leaves you with a truly fascinating and, I don't know, somewhat unsettling question to ponder as we wrap up this deep dive. For decades, the greatest macroeconomic minds utilized careful, deliberate, and highly sophisticated domestic policy in an attempt to pull Japan out of its stagnant, deflationary trap.
Right.
And largely, those deliberate policies failed to break the psychology of deflation.
They really did. It took an uncontrolled, highly destructive external shock, a rapid, chaotic currency collapse combined with global energy inflation to finally shatter that deflationary mindset and force a structural shift in the bond markets.
Yeah.
If you are analyzing the global economic landscape, it raises a really provocative thought. In highly entrenched, stagnant economic systems, could extreme, painful volatility sometimes be the only mechanism powerful enough to force a reset?
Wow.
Is it possible that chaotic external shocks, despite the severe short-term pain they inflict on consumers, act as an unorthodox cure for economic stagnation, rather than just a symptom of global instability?
That is heavy. It certainly makes you question how much control central banks actually wield when the global macroeconomic tide decides to turn. Keep a close eye on those Japanese bond yield and the exchange rates, because the unwinding of a 30-year economic era is going to send ripples through every major market on Earth.